Democratic Senator Sherrod Brown of Ohio issued a statement that, quote, Burger King's decision to abandon the United States means consumers should turn to Wendy's old-fashioned hamburgers or White Castle sliders. Burger King has always said, have it your way. Well, my way is to support two Ohio companies that haven't abandoned their country or customers, the senator said. Both Wendy's and White Castle are based in Ohio. Brown also called for the creation of a global minimum tax to eliminate incentives for companies to move. And I would like Tim Dickinson to comment on this. Tim Dickinson has written extensively about these kinds of deals and others for Rolling Stone, where he's a contributing editor. Talk about this and then what you call the biggest tax scam ever, Tim.
Well, so the inversion trend is just the tip of a very destructive iceberg that's seeing the hollowing out of our corporate tax base. And so the inversions, is just basically a legal scam that lets a company technically offshore itself for a lower tax rate. And it goes sort of hand in hand with companies shipping massive quantities of corporate profits overseas through sort of elaborate accounting schemes. And while it's overseas, it sits there tax-free, accumulates tax-free, kind of like a 401k does. And so right now there's about $2 trillion in corporate profits that are stockpiled overseas, on which the U.S. government is technically owed something like $500 billion. So at the same time that we're cutting food stamps, that we're cutting home heating aid to the elderly, there's literally a jackpot of $500 billion that politicians on both sides of the aisle just won't go after, because there's just an imbalance of power there. The corporate power has grown much greater than state power in this case.
And Tim Dickinson, one thing that many of these companies that are parking their profits overseas keep quietly lobbying for is amnesty. Right? They want a tax amnesty where the government would lower their taxes temporarily so they could bring this money back. Could you talk about that and who in Congress champions that?
Well, it's like a bailout, basically. It's a bailout on the tax bill. And this was done in the Bush administration in 2004. The nominal U.S. tax rate, nobody really pays it, but the nominal rate is 35%. In the Bush era, corporations were allowed to bring their money home at a rate of 5.25%, 5.25%. So basically 30 points shaved off of the tax rate. And so politicians of both parties really kind of are attracted to this idea. There are a few folks who have raised enough of a stink about it that it hasn't happened. But literally both sides of the aisle, most recently Harry Reid and Rand Paul were shopping a bill that would allow corporations to bring cash home at a low rate of 9.5%. Dave Camp, the chief tax writer in the House Republican side, as low as 3.25%, I believe. And then on the Senate side, Ron Wyden's bill would again allow 5.25% tax holidays, what the jargon is.
So, Jim.
I was just going to say the 2004 experiment with this idea is illustrative. I mean, about a third of the benefits from that went to one company, Pfizer, and they proceeded to lay off their employees. It produced no jobs. Essentially, management got rich because they used the money for management buyouts and for shareholder share repurchases. So it's a good example of how bad this idea is.
Tim Dickinson, you write about Google, you write about the company that makes Viagra, you write about Apple. Tell us about what they take advantage of.
Well, so there are a myriad tax schemes by which U.S. profits are funneled out of the country in ways that make them look like costs. So to take Pfizer, for example, on Viagra, they had transferred at the very early stage of drug development the economic rights to the intellectual property behind Viagra to a shell company in Liechtenstein, which is a tax haven in Europe. And so on every sale of the drug here, the Liechtenstein company would charge a very steep royalty. And so the American company would appear to not only not make any profit on those sales, but actually be creating a business loss here in America because they had to pay this business expense to its own subsidiary. And so you're lowering the tax bill on the American side, even as you're increasing the profits on the Liechtenstein side. So it's this incredible racket, basically, and it appears to be legal. This is not, something that has been cracked down on by Congress, but the white shoe accountants have figured out a way to sort of disappear this money and put it overseas. And I should mention that the U.S. has a global system of taxation. So that corporate profits around the world from American-based multinational are supposed to be taxed, and that reflects the idea that the U.S. Navy secures shipping lanes, that our courts protect intellectual property across the world. So, and this has been practice for more than a century. The Supreme Court approved since 1924. So this is not a new idea, but there's sort of an incredible amount of accounting innovation that has gone into figuring out how to make profits disappear and in fact appear as losses in the United States as the cash piles up in foreign subsidiaries, which in turn bank their money right back here in the United States. And then when the CEOs need to use that money here in the United States, there's something called synthetic cash repatriation, where they're able to use the same sort of accounting tricks either through short-term revolving loans or through bond offerings here in the United States, as Apple has done. And so the cash can the power of the cash can reappear here in the United States. And the only one cut out of the loop is Uncle Sam, who's supposed to get 35% at the moment the money returns to the country.
Well, James Henry, I'm curious why there isn't a greater public outcry over this. You essentially have American companies who take advantage of the protections that the American government provides, the patent laws, the intellectual property laws, as you say, the military that assures international commerce goes on. They take advantage of all the benefits of the government, but then they shift their money overseas where they don't have to pay taxes to finance the very government that provides them that protection.
Well, that's exactly right. And small business is not benefiting from all these tax games that multinationals are able to pay, and they're having to compete with these companies here. It really has been a growing movement, I think, in the tax justice movement. We made a film called We're Not Broke, which is on Netflix and is about this very issue of corporate tax dodging. The outrageous behavior of these companies offshoring their intellectual property that was paid for by U.S. R&D subsidies here to places like Ireland and Bermuda, where they have no research labs, and then paying themselves royalties tax-free. The outrages are clear. The issue is these are very powerful lobbies. The corporate tax lobby employs 1,800 tax lobbyists full-time in Washington working on these issues, night and day. I mean, I assume they take time off for Burger King once in a while. But the issue is, we're just outgunned on the level of the substance and the
three for every legislator in Washington, Congress, and senators.
Absolutely, and
of course, much more.
I mean, this lobby has actually grown in power as the tax rates have actually fallen since the 1980s. I mean, we now have cut corporate tax rates in the United States roughly in half. There's a race to the bottom worldwide, and this is just has to be seen as part of that global phenomenon. So if the United States persists in cutting its tax rates, it's going to have terrible impact on other countries, developing countries in particular. If there's no corporate income tax in the United States, there's no tax credit for the taxes that American companies pay abroad, and so those countries will be forced to reduce their tax rates as well. So, this is not just about inversions. It's part of a growing, I think, very radical movement on the right to essentially get rid of the corporate income tax.
Well, last point, I asked you about Google and Apple. Tim Dickinson, if you could just explain what they do as we wrap up.
So Apple has this amazing deal where they've got essentially a shadow company in Ireland, and it's incorporated in Ireland, but for Irish purposes, it's an American company, and for American purposes, it's an Irish company. And so you end up with this black hole of taxation where, in fact, this Apple subsidiary files a tax return to no government in the world. And so it can use all kinds of accounting tricks to funnel money to this company, and they sit there essentially absolutely untaxed. Just there's no tax return, and so you have billions of dollars sitting there. And again, when Apple needs billions of dollars to fund its American operations, it has bond offerings, and its cost of borrowing here in the United States is incredibly low. Just investors are virtually paying Apple to raise this money because it's secured by these massive piles of cash, technically abroad, although they're actually banked reportedly in Manhattan. And so, I believe that this is a phenomenon. It really, I mean, we talk about it as a right-wing phenomenon, but it has infected both parties. That there is no meaningful party out there that is trying to address this. In fact, both parties now agree that there should be we should shave 10 percentage points off the tax rate, get the American corporate tax rate down to 25%. That's a race at the bottom that America can't win. There's no way to run a global superpower and compete with low-tax nations like Ireland. But I just need to emphasize that this is truly a bipartisan scenario. Both parties are pushing corporate tax holidays. Both parties are pushing to lower the corporate rate, even though the effective rate that companies pay here on their profits is actually, in many cases, lower than the effective rate that they pay in other countries.
Tim Dickinson, we want to thank you for being with us, covering national affairs for Rolling Stone, where he's contributing editor. We'll link to your latest piece, which is called The Biggest Tax Scam Ever, speaking to us from Portland, Oregon. And thanks so much to James Henry, the former chief economist for McKinsey & Company, lawyer and senior advisor with the Tax Justice Network. This is Democracy Now! When we come back, the activist guide to archiving video. What happens when you take a video on your cell phone? What should you do with it? Stay with us.